Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from Chartsandmarkets.com runs down the major markets, calling them buoyant. He notes November is usually the best month for the stock markets, with a pullback expected after U.S. Thanksgiving. Ross also points out Bitcoin has seen an 80% gain, but is due for a correction. Ross also has a special offer for our listeners. InsideTrackTrading.com President Eric Hadik examines the cycles that affect Bitcoin, gold, silver, the U.S. and Canadian dollars, the stock markets, and crude. Checking in from Calgary, founder of the SchachterEnergyReport.ca, Josef Schachter, drills into what the Trump administration could mean for oil and gas in both Canada and the U.S. It could be good times for pipelines once again. We'll talk to Ross Clark right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from Chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on X at Charts by Ross. Welcome back to This Week in Money.
Good to be with you, Jim.
How would you describe what happened on the stock markets this week?
Well, another buoyant week after a bit of a pullback. We had that, it was about 5 or 6 day correction into November the 19th, and got some nice oversold conditions as far as the Dow and the Russell were concerned. These were minor corrections, just getting into short-term oversold readings, coming back to kiss the breakouts. The S&P and the NASDAQ were a little deeper on their corrections, but the Dow and the Russell held up very well, and this week they bounced back. Here you are with the Dow at all-time highs again. And, this is the movement into Thanksgiving, which historically is one of the good stretches. It's part of November being the best month of the year historically. So at this point, hopefully it continues up into Thanksgiving. A correction shortly thereafter would not be a surprise. I think we do need to use that low on the 19th as a pretty significant support level. And that would be for all of these broad indices, no question at all. That would include Canada as well. The TSX had a great week, but want to be wary of that one as much as anything. The signals there are very overbought for the TSX, so be cognizant of where to place your stops and not be overly committed. So, as we get then into December, which is the second best month of the year, you once again want to be careful there to see if there's any faltering on the upside. We've had this real strength in the U.S. dollar big time, and the dollar index has now we're up at just around 108. This is an index that was at 106 and change back at the end of September. So for a currency, this is a really, really large move. And the reason I sort of bring this up now that we're talking about the market is that when the dollar index has been not just in a mild uptrend, but has become very strong, we end up seeing, when we look back, that the stock markets then tend to lose their upside momentum. They go into a real choppy phase and can quite often roll over. So with the dollar index moving at the pace that it is right now, this becomes another reason, as far as the equity markets are concerned, to just be especially wary.
Well, we're talking about currency. What about the Canadian dollar?
The Canadian, going along with all of the others, ended up with a recovery during the week, but fell back at the end of the week at 71.50. We had got some extreme oversolds as far as not just the Canadian dollar was concerned, but the euro, the Swiss franc, the British pound. all about a week ago. They all had decent bounces, but failed a little bit at the tail end of the week as the U.S. dollar came back to show strength. The Canadian dollar, I would think that the support that we've seen in early November around 71 and 80, we've bounced back to test that, but that's a pretty critical resistance level for the dollar at this point.
What's going on with crude?
Crude, we ended up rallying back to 71.5 this week. I guess that's part of the geopolitical tensions that are out there. And, it's a bit of a surprise to me. We've had 4 tests now of the $67 level, and the resistance is clearly not much further above where we are right now. But, from a seasonal perspective, we should be looking for a potential high and then, erosion down and create a December-January base. So could be we're getting a premature one, but I'm still going to hold off on the basis of looking for lower lows as we move towards the end of the year.
What's the story with gold?
Great week for gold. We had a pullback there, just like we had seen in the most of the markets a week ago. And the dollar or the gold market, we got down to 25.50 on the end of last week. This week we're back up to 27.16. This is based on the spot prices. We had both silver and gold put in what we call sequential nines. So this was 9 days down, consecutive days with closes below 4 days earlier. That occurred as of Tuesday, the 12th of November. And in uptrends, the gold market has, if we take a look at the GLD, the ETF, 75% of the time that we've had one of those sequential nines kick in as a buy setup in uptrends, 75% of the time we have an extended rally that lasts a number of weeks. So this one now, we've got, let me just count this, 1, 2, 3, 4. So we've had 7 consecutive days on the upside right now. We're back, getting close to the all-time highs again. I would think that there's still some more room left on the upside for the gold market. And when you get the concurrent signal that we had with silver, that's supportive as well. If we look though at the miners and at the silver markets, those, for all that they got oversold, been pretty mediocre bounces right here. So the flight to safety or quality, I would say, has been more into the, say gold, and you saw it as far as maybe the Dow was concerned, big money moving into those type of stocks. And then the big one on the week here, the big one in the last couple of months is Bitcoin. Bitcoin is up now 80% since the September lows. We've got now 9 consecutive weeks on the upside as for the sequential count there. We've had about a dozen of those in the history of Bitcoin, and most of those then put in an interim top within the next week or two. The longest stretches, I think one of them was stretched out to 4 weeks. But this one now, having reached just shy of 100,000 level, could be setting up for a correction nearby. On a daily basis, the counts there, we're looking at the sequentials. There is the count we look for on the combo is up to 13. We are currently at 10. So if we continue to see strength in here, another 3 days of upside action, and that doesn't have to be concurrent, those are consecutive. We're just looking for a series of higher highs. Once we get to a 13 count, then the first day with a lower low would end up being a pretty good catalyst for a correction in Bitcoin. I mean, the type of action here is really quite something. It's the talk of the town, and by the time you get to being this popular, having had everybody move basically flatlined and away from it during the preceding couple of months, here from the spring right up until the October, we'd gone nowhere. We were 60,000 plus or minus 5,000 for a number of months, and now with this action as big as it is, let's be thinking about a correction as far as that group is concerned.
And Ross, in time for American Thanksgiving, you're ready to pour a little extra gravy on the turkey and mashed potatoes?
Sure we are. And, we had ours earlier, back a month ago, but hey, maybe it's time for the second turkey. The Canadians can always celebrate the American Thanksgiving.
So that means a special offer.
Yeah, we're going to do 25% off for new subscribers, and we'll make that good through the Thanksgiving weekend.
Ross, thank you so much for chatting with us.
Pleasure to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. Find him on X at Charts by Ross. Coming up, Eric Hadik next on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Eric Hadik, CEO and president of InsideTrackTrading.com. He's speaking to us from Central California. Eric, welcome back to This Week in Money.
No, thanks for having me back, Jim. It's my pleasure to be here.
Can you tell us a bit about Inside Track and how our listeners can subscribe?
Inside Track is a subscription-based publication service that provides analysis, technical and cyclical in nature, along with corresponding trading strategies, focused first and foremost on the futures markets, but a lot of derivatives from there that the analysis applies to. And so we provide anything from weekly and intra-week update services to monthly and intra-month and longer-term type analysis. And any listeners can find out more information, see the different subscriptions, locate a lot of archived publications on our website at InsideTrackTrading.com, and that's inside with an extra I in the middle, so it's INSIIDE, TrackTrading.com.
Bitcoin's in the $100,000 U.S. range. What does that tell you with your Bitcoin cycle?
Well, Bitcoin has been accelerating higher into a cycle peak, as you would kind of expect at the culmination of a particular cycle. Back in March, when we initially peaked, I had done some reports leading into that, and then following that, that showed how Bitcoin had a very consistent 8-month and 16-month cycle over the last at least 5-6 years. Obviously, the data is a bit limited on something like Bitcoin and cryptocurrency, but it had already shown some great consistency with that cycle. And so even back then, I was talking about November being the next phase of the 8-month cycle and the midpoint of the 16-month cycle. And if future expectations for a more significant peak out in 2025 were going to be corroborated, then we should see a peak in November of 2024. And so that's continued to be the focus. And then in July and August, Bitcoin fulfilled a very consistent 10-month cycle between its lows. And it was really in early October when it set up from a technical perspective. The cycles had already bottomed. Then you look for some corroborating technical action and some corresponding buy signals. And that really took place in early October. I published a special report at that time saying, again, that Bitcoin should see a sharp rally into November, and put a follow-up to that report in early November saying the same thing, that we were entering into this more the parabolic stage of this particular cycle, and published several upside targets that were in the mid $90,000 mark on Bitcoin. And so we are just attacking that now as we're fulfilling those cycles. Of course, with a parabola like this, you're usually wise not to try and pick tops, except for lightening some of your long position. You can kind of stage into that. But we're coming into those cycle highs and attacking those upside targets. It's probably going to try and spike above 100,000. That's just such a psychological point to reach. But I do think that Bitcoin is going to put in at least a 2 to 3 month peak in November. And once that peak is in place, I'll start focusing both on when I think a pullback or correction low is most likely, and there already is a time frame setting up for that, and also when I think the next even more significant peak is a much higher probability, and that's already starting to take form.
Gold topped over $2,800 an ounce at the end of October, then pulled back. What do you see ahead for the gold cycle?
Gold has adhered to a really consistent multi-month cycle for almost the last 10 years, really since the low in late 2015 and the initial rally in 2016. Gold has just consistently moved on a 12.5 to 13-month cycle, which on a weekly basis is usually between a 54 and 59-week cycle. And that has timed many consistent lows, and then in sync with how I use my cycle progression tool, you get a certain number of consistent lows, and then a market is ready to break into a full-blown uptrend, and that cycle will invert. During the inversion, you'll get a 12.5 to 13-month rally, and then once you get an initial peak, you will then see some successive highs at that same interval. All that to say is that gold has once again been adhering to that cycle, and when it set its low in September, October of 2022, it was reinforcing that cycle, and then it set a higher low in October 2023, and it was getting ready to enter that bullish phase where you see an inversion of the cycle. And along with a lot of other factors, it's not just that cycle, it's the synergy of many. But along with that, you had gold focused on late October of 2024 as a convergence of a myriad of cycles that all were projecting a multi-month peak. And similar to what I was talking about with Bitcoin into these November cycles, gold kind of had its last push up into late October. At the same time, the XAU index and also silver had not only monthly cycles like that, but weekly and daily cycles pinpointing October 21st, 22nd as the most likely time for a peak. And that's when those markets set their tops. So to answer that question, I think that gold has certainly fulfilled upside targets and cycles, and that reinforces future cycle highs. All of my work says that gold is still only in the midst of a much larger bull market, but that this was the time for a significant pause in that market, and gold's recent sell-off in magnitude or in price basis just matched the magnitude of its early 2024 decline, actually it's late 2023 to to early 2024 decline. So you've got some wave comparisons that are showing some strong support down around the 2540, 2550 level in gold. And it could see a trading range between that support level and the $2,800 resistance that's been formed by the recent highs. So I'm looking for some volatile trading in here for a little while. Silver and the XAU index are showing that they could see another leg down into some future cycle lows. But it's all part of a corrective phase, in my view, that's going to ultimately yield to another move up in gold in 2025.
Silver topped over $35 an ounce in October, then pulled back. What do you see ahead for the silver cycle?
Well, silver, as I said, was fulfilling some strong related cycles right around October 21st, 22nd was when the greatest synergy of them came into play. But from a technical basis, which really all of my cycles are used as a backdrop, they're used as some potential timing, but they also have their weaknesses as far as specificity from a price standpoint and a trading standpoint. So I treat them as a backdrop and then start to look at the technical price action for validation of those cycles and for signal triggers. And so when you had silver running up into that peak, it was also fulfilling a very consistent or very clear five-wave sequence from its October 2023 low, which tells you that that overall wave is due for a higher magnitude correction, which is what I think we are seeing here in silver. It's got its strongest support down around $27 to $28, and really the action of the current week should help determine whether it could get as low as that $27, $28 range in the coming weeks, or whether it could bottom out a little bit higher than that. But the price action is showing that we are definitely in a higher magnitude correction. It's probably going to take longer too, which means you end up in a protracted trading range between those highs and the support that I just cited. And so I think that it's like gold, but even more so for silver, has entered a consolidation phase that is probably going to be intact for at least a couple of months.
Since the beginning of October, the U.S. dollar has had a huge move to the upside. Would cycles be able to predict if the U.S. dollar will remain strong through the Trump presidency?
There's a couple facets to that, or a couple answers to those questions. First, just addressing the dollar index and the action of the last month or two. In late September, I was explaining why a lot of cycles, intermediate cycles, were looking for a bottom in late September. But it was a price-based technical sequence of events that really had me convinced we were going to see a low in September, October, and then a strong rally from that. And this was a more of a lagging, confirming indicator that I watch in all the markets. But in the dollar index, it had been going through that sequence for over a year. And then at the end of August, it gave the confirmation signal to that pattern. And what I explained to my readers in every case of an indicator like this, it's not only a lagging, confirming indicator, but very often it is completed or triggered right near the end of an initial move, in this case, an initial decline. And so that was coming together along with the intermediate cycles in late September and some very critical intermediate and intra-year support in the dollar index, all saying that we should see a rally in October and November. And you really had a combination of interest rates and some other factors, but really the interest rates starting to move higher and bonds selling off during that time frame that began to bring some money back into the dollar, strengthen it up. And I've been saying all along that from that September-October cycle low, the dollar should see a couple-month rally and then set a multi-month peak either at the very end of 2024 or possibly stretching into January of 2025 when cycles begin to turn down with a little more conviction in and after January. As for the relationship between the dollar and presidency, we've had this conversation many times going back to even 2015, 2016. But what my work has shown for the last 40 years, really since the 80s and since the major peak in the dollar that the powers that be wanted to see the dollar selling off, and then the Plaza Accord in late 85, all of those things, all those factors initiated this pattern that has played very consistently throughout administrations in the U.S. presidency, where you see a stronger dollar during Democratic administrations and a weaker dollar during Republican administrations. And there's a lot of reasons for that, and some have very little to do with the political party in power. But even starting back in the 80s, one of the objectives for what was it then at that time, the Reagan administration, was to see a lower dollar, which would help increase exports and make American goods a little more affordable on the global stage. But there was a lot of other factors went into that. There's also deficit spending. There's even geopolitical factors that seem to concur with that pattern. And so when we were talking back in 2016, I was describing how my outlook for the dollar, and it's really, that's what's more important, is not what the dollar is doing right now, but what it's going to do in a future administration, or at least what it looks like is the higher probability action during that future time frame. And the dollar was looking like it should see a peak in late 2016, early 2017, and then sell off. And that led me to the conclusion back then that we talked about, where I thought a Republican would be in office. That was before Trump was even the confirmed candidate. And the inverse of that, as we came into 2020, the dollar was showing that it was bottoming out and due for a pretty sizable rally. And that was leading me to believe that a Democrat would be in office during that time frame, which is what we had take hold in late 2020. Well, all through this year, I've explained why I thought that the dollar set its peak in 2022. We'd get this initial decline that we've seen, then we would get a rebound. But once we enter 2025, my work is showing that the dollar should actually see some more significant selling, and that, again, would be very consistent with a Republican administration. At least the last 40 years of history and cyclic action corroborates that conclusion. So the two are certainly working hand in hand, that the outlook continues to be that the dollar could see a significant decline in 2025 and 2026, and that we now have a Republican administration on track to take office.
The Canadian dollar is doing the opposite of the U.S. dollar, hitting lows not seen since March of 2020. What do you see ahead for the Canuck buck?
Well, the Canadian dollar is often tracking the movement of crude oil in the energy markets. And whereas we can talk a little bit about that specific analysis in a few minutes, one of the things that we have seen is, on balance, the crude market, the energy market, working lower through a good part of the year until cycles bottomed there in September of this year. And so that has certainly been one of the factors weighing on the Canadian dollar. Obviously, it has many of its own factors as well. But more recently, the Canadian dollar has kind of seen a similar cycle to what I was describing in gold. And I'm not saying that there's any direct correlation there between gold and the Canadian dollar, but that particular cycle, that 12.5 to 13-month cycle, 54 to 59-week cycle, has been consistent in several markets. So it certainly is something that warrants monitoring and consideration. But in the case of the Canadian dollar, you've seen a series of lows, with the third in that series of lows coming into play right now if the Canadian dollar sees a bottom in this time frame. So in other words, that cycle is arguing for a bottom here and in this mid-November time frame. And so I think it is getting to the extreme of a bear market or a down wave, and along with what I'm looking for in the energy markets, that could also help set a floor under the Canadian dollar and start to go through a basing process. So I think we are very close to a significant bottom in the Canadian dollar, and I'll be watching both the action of that market as well as corresponding action in the energy markets to see if they're both supportive in the coming weeks and months.
The Dow and the S&P 500 hit new all-time highs earlier this month and have since pulled back. Could the Dow and the S&P 500 continue to hit new highs in this cycle?
They could certainly do that. You never want to bet against a strong bull market like that. But a lot of my work has been showing that we should set a pretty significant peak in the fourth quarter of 2024, and that incorporates a host of cycles ranging from multi-year, multi-decade cycles, most significantly the 17-year cycle that I have discussed at length, and its last phase was a peak in the fourth quarter of 2007, so we're right in that time frame for a recurrence of that 17-year cycle. But there's a lot of other intermediate, both monthly and weekly cycles that back in September, October were telling me to look for a rally in October, then a pullback, and then a final rally into late November. One of the indexes that I was watching closest, which had the greatest synergy of those cycles, was the S&P Midcap 400. But there are several other indexes that are tracking pretty closely with those cycles, and they're all telling me to look for a multi-month peak in or by late November. So we're coming right into that time frame, and I'm watching for signs of a top. The NASDAQ 100 appears to have already put in a top. It still needs some confirming action, but all it did in earlier this month was go back up and retest its July peak, so it is not showing near as much relative strength, but it still needs to give a close below 20,400 in the NASDAQ 100 in order to confirm a top and elevate its correction to a higher magnitude decline. So we're coming right into that time frame when cycles for me should start to turn down either at the very end of November or the first part of December. And so now I'm watching for technical price action to give me some indication of when that is taking hold and what it's projecting.
The NASDAQ also hit new all-time highs earlier this month. Is the NASDAQ cycle in sync with the Dow and the S&P 500?
For the most part, it is in sync with those. But like I said, on a relative basis, price action-wise, it looks like you're starting to see a bit of a rotation out of tech stocks, and the fact that the NASDAQ 100 could only retest its July peak, doing it exactly 4 months later, is telling me that there's some underlying, maybe not even weakness yet, but lack of confirming strength underlying that market. And you have seen several of your major tech stocks already put peaks in weeks or months ago. A few of them are still holding it up, and yesterday's Nvidia earnings could even be the type of thing that gives a final spike high. But you are seeing indications of a top forming here. So I think that the NASDAQ 100 could be an index that leads a sell-off in the not-too-distant future.
The Russell 2000 is retouching highs hit in 2021. Where is the Russell 2000 in its cycle?
That index has been a very intriguing one for me, and it's not as much the cycles as it is the price action that has really intrigued me over the last 3+ years. And in fact, just yesterday I did one of my weekly relay alerts, which I'd be, if any of your listeners wanted to reach out to us and request a copy of that, I'd be willing to send a free copy. It's the November 20th weekly relay alert. And that I was discussing a series of trading ranges that I've seen in the Russell 2000 for many years. And most recently, it just came back up to the upper extreme of one of those trading ranges, right around 2460. And that is exactly where it peaked in November of 2021. So you've got some real equilibrium or symmetry, whatever you want to call it, where it's taken 3 years for the Russell to first sell off for about a year, then go sideways for about a year and set a secondary low, or it actually was its lowest weekly close that just barely spiked below its previous low in late October, early November 2023, and then a year from there of an advance. So it has been a very somewhat predictable but symmetrical type of movement in the Russell 2000, and we've come right into the culmination of this overall sequence, and I think it's going to find some very strong resistance right around that 2460 level, and it could be setting another top exactly 3 years from its preceding top.
Crude oil is off significantly from its peak in March of 2022. War drums are beating. What do you see ahead for the crude oil cycle?
Crude oil and the overall energy complex, and in this case, natural gas is actually even tracking close in synchronicity with the other oil markets, which is often not the case. But in this case, they have all had cycles, multi-month cycles bottoming, first in crude, unleaded gas, and heating oil in September, and then in natural gas more recently, in recent weeks. And that also goes along with a commodity index that I watch closely, the Goldman Sachs Commodity Index, which is weighted more heavily in energy products. So you would expect it to track pretty closely to the price of crude, but it does have a lot of other commodities in there that can contrast the movement in crude. But that also had major cycles bottoming in September of 2024. And so I think that we are in a bottoming phase for the energy market, and that we could be on the cusp of a decent rally in, like I said, the oil markets, but also natural gas. My work generated a buy signal, an intermediate buy signal in natural gas this past Friday on the the 15th, and it is telling me to look for an initial surge up to about 360, but it could see much higher levels than that in the coming months if some corroborating technical action is triggered during this initial rally. So with natural gas cycles bottoming in early November, I think that you're looking at an initial surge into early December, but then crude and some of the other products are looking at late December, early January as the time for an intermediate high. So you could see those markets trending higher through the coming weeks.
Lithium is looking like it could have put in a bottom. Does lithium have a cycle you follow?
I have been watching lithium a little bit more in recent months. It's not a market that I focus on or publish analysis on, but I've been interested in it because I thought that it was getting very oversold. And from what I could see, there is a cyclical argument for a 1 to 2 year bottom here in this fourth quarter of 2024. And so I also looked at a lot of the a little bit better known lithium stocks just to see what their technical price action has been like. And a lot of them seem to have led a low that they bottomed before the actual price of lithium. And they're going through a sequence of technical moves that help me pinpoint not only a bottom, but when that bottom is ready to transition into a more significant up move. And a lot of those stocks have fulfilled 4 of the 6 steps that I look to see in this sequence. So they could be corroborating the potential for a bottom in lithium in this time frame.
Can cycles be tied to human psychology in the markets?
Oh, very much so. And I think that particularly when you're talking about the markets, that cycles and a lot of your technical analysis is at its most base foundation a measure of mass psychology. And whereas I think that a lot of cycles are governed by natural events, I do think that market moves and market swings are a combination of those natural events and human psychology, human reaction to those events. So I would say 100% yes, that I think that cycles are directly linked and closely linked to human psychology in the markets.
Where can listeners subscribe to Inside Track with 2 eyes?
Once again, they can go to our primary website, InsideTrackTrading.com. Like you said, that inside has an extra I in the middle, so it's INSIIDE, TrackTrading.com. And they should be able to find all the necessary information to really let them know more about what we produce and what we offer as far as subscriptions at that website.
Eric, thank you so much for being on This Week in Money.
Thanks for having me back, Jim.
My guest has been Eric Hadik, CEO and President of InsideTrackTrading.com. Coming up, Josef Schachter, next on This Week in Money.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is Josef Schachter, founder of the Schachter Energy Report, online at SchachterEnergyReport.ca. That's SCHACHTER EnergyReport.ca. Josef, welcome back to This Week in Money. And how are things in my hometown of Calgary?
Cold, snowy, windy, and probably more snow in the next 24 hours. So It's a winter wonderland here, and you got to make sure you get used to driving again in the winter. We were fortunate; we got our cars winterized about 3-4 weeks ago, so we were ahead of the crowd. And when we go out, we make sure if it's a normal 10-minute drive, we give it 20 and 30 minutes.
Yes, and I love the Swedish saying that there's no such thing as bad weather, only poor clothing choices. Calgary, a great city to live up to that.
Yeah, no, I pulled out my winter boots yesterday, so if I go for a walk with the dog, or if I go outside for any length, I'm ready for that, and winter coat's out. So I even found my toque, so I'm ready.
The latest issue of Ion Energy is hot off the press. Can you tell us about it and where our listeners can subscribe to it?
Yeah, Ion Energy is our free product that we provide, so people can just go to the website, www.Schachter.energyreport.ca, so SCHACHTERENERGY report, REPORT.ca. And that macro piece covers what's going on around the world, the political events and economic events that affect the price of energy, both oil and natural gas. And then we talk about the latest EIA petroleum data, EIA natural gas data. The OPEC monthly report came out, so we covered that in there. And then I talk about how I see that affecting the markets. Right now we're in the window for tax loss selling season. You can say that that's not really applicable today because the index today is up on a Friday, but a lot of stocks are down from the April highs, and that's where the bargains are, and that's what we write about in our regular paid subscription product, and then we're going to cover that in more detail next Thursday when we have our quarterly webinar, and there'll be two main themes there. What does Trump mean for the Canadian energy industry? And we can talk about that somewhat today, and then going through specific recommendations of stocks that are being taken down, not because of fundamentals in the company, but just because the sector is under duress and people who've taken capital gains in other areas earlier in the year are wanting to help shelter some of those gains from our friends in Ottawa. And so tax loss selling will continue through mid-December, and I think over the next 3 weeks we'll probably see lower prices, but that will give you great bargain opportunities for investors. And historically, from tax loss selling bottoms, usually get a wonderful bounce into Q1. And if I'm right that right now we've been talking, and as you know, for the last number of discussions, that I thought the price of oil was going to go below 70. We're 71 today because of the increase in the weaponry being used by Russia and Ukraine, with Biden's approval from Ukraine, and then Russia using these intermediate intercontinental missiles. So it's an upgrade. Biden is supposed to be a lame duck president, but he's more of a war president now. That seems to be one of the only things he wants to do is really help Ukraine, and making it more difficult for diplomacy to be, the first item of choice for the incoming administration on January 20th.
Focusing on the U.S. first, where President Trump won in a landslide, how do you think this is positive for the U.S. energy sector and the economy?
Well, I think, of course, it's going to be positive. Lowering corporate tax rates in the states, removing a lot of the regulations that have kind of meant it's very hard to start a business for small and medium-sized companies. Also, energy, talking about a continental energy policy. His picks for Secretary of the Interior, Doug Burgum, and then the pick for the energy minister, the fellow who works was chairman of Liberty Energy, which is one of the biggest frackers, works in both Canada and the United States, is a positive. And then the trial balloons that we're hearing about the last few days, where they're talking about maybe bringing back the XL pipeline. Again, TransCanada, I believe, still owns it through Bow, South Bow. And again, there was a legal suit. They've held that back now. And if there's some way to reignite the project, a lot of money's been spent. The Alberta government put some loan guarantees in. So there's going to have to be some resolution of these financial issues. But the key that they want to put that pipeline in means they want to integrate the pipeline systems between Mexico, U.S., and Canada, so we are not only self-sufficient, but we're an energy exporting giant, because there'll be LNG exporting going from the west coast of Mexico. The Gulf Coast is probably going to see a doubling from 14.4 BCF to over 30 BCF before the end of the decade. Canada, in the mid 2025, we get our first 2.1 BCF LNG Canada project, and potentially by the end of the decade, 6 BCF. So we're going to be able to provide the world with sufficient cleaner burning fuel so they can stop using coal, dung, and clean up the environment, which of course is something that needs to be done. Right now, they're talking at COP 29 of $250-300 billion here or there. But they don't talk about China contributing or India contributing or what they're going to do to clean up their air. You hear the reports this week about Delhi, the air being horrible and the quality of air being terrible, and yet there's no commitments by them to clean up their environment. And I don't think Trump's going to play ball with the climate activists if he doesn't get a buy-in by the countries that are the big emitters, that anything we do in Canada and the States gets totally overwhelmed by them bringing on more coal-fired facilities, which bring on more bad emissions. And then we put up more solar, we put up more wind. We do the right things. We do. And nuclear is going to be a bigger issue with these small modular plants. All the things that are talked about, Germany and Japan, we're going to close down. We're planning and did close down their nuclear facilities. Now they're saying, hey, maybe these small modular reactors that don't have the same problems like Fukushima had are going to be the answer. And that, I think, will set the stage for a massive amount of capital expenditures. Data centers need more. The grid in the States needs to be rebuilt. Quebec is under capacity for electricity, as we saw when they wanted a bid for EV plants and battery plants, and of course they didn't have the electricity to provide. So to me, the next 5-6 years is going to be a major energy capital expenditure boom for all types of renewables and also for LNG, natural gas, cogen, because data centers are going to be a major user of electricity, and we're going to have to build up, massive amounts of new cogen and these small modular reactors if that that AI world that everybody is talking about is going to be developed.
Now, Canada, what effect do you think President Trump could have on the Canadian energy sector and the Canadian economy?
Well, the Canadian energy sector, I think, is going to be good because the U.S. refineries on the Gulf Coast use our heavy oil. Midwest refineries the same, and his talking about drill baby drill means that he wants to see the Eagle Ford and the Permian, pick up, and of course they have the ability with some other areas, North Dakota, etc., to grow by 2 or 3 million barrels a day. So from 13.1 million, we could see 16 million plus before the end of his 4-year second presidency. And of course, that requires a lot of capital. One thing I don't buy is he talks about the price of gasoline going down in half and the price of oil going down in half. Well, the industry's not growing with $70 WTI. If they had $40 or $35 WTI, they'd be shutting in a lot of wells. The Federal Reserve of Dallas does some good charts, and they show that the industry break-even is between $65 and $70 WTI. So we need much better than that. My view is that we'll be in a 70 to 85 range in the first half of 25, and I think in the second half of 2025 we're going to be over $90 a barrel for WTI. and that's why I'm very bullish on the sectors. And I think natural gas, which is now over $3 for NYMEX, which is a good price in the industry, can start moving, but they probably want $4 consistently to start spending more money on drilling for natural gas. I've got the Baker Hughes drilling data today, and the drilling stats for the states. The rig count is down 6.3% from a year ago, but gas rig count is down 15.4%, and the oil rig count is down by 4.2%. So you need to have much better prices for that rig count to go up. Everybody knows how to do long reach horizontal wells, so they talk about drilling in less time than they did 4 or 5 years ago, but not much improved efficiency over a year ago. In Canada, our rig count is down 8.2 for gas-focused rigs, and that includes, of course, liquid-rich natural gas, where we're seeing an increase up 7.3. So 133 rigs up from 124 is due to the TMX pipeline and more heavy oil drilling and more drilling for SAGD as they have more capacity to move oil, not just south, but also to move oil to the West Coast and then to buyers overseas.
Any thoughts on how the heads of U.S. government departments could affect Canada, especially the Secretary of Energy?
Well, the Secretary of Energy, I think, will be, will find a very friendly audience in Saskatchewan, Alberta, BC. I think you're the wild card, given the challenges your government has. The left wing, and I gather your energy minister is not pro-energy for sure. So I think Alberta and Saskatchewan will be talking a lot to the U.S. about integrating the systems more and developing more. And again, if the XL pipeline gets some traction again, and they find around solutions around these financial issues, then we could be talking positively. Where I'm cautious and concerned about is the tariff side. We have surpluses with the United States on trade, but a lot of that is resource and grain and lumber. But a lot of it is still manufactured goods in Ontario and Quebec. So that's where the government in Ottawa is going to really have to be very careful on how they negotiate and what tariffs get put on us. I would say that between Mexico and Canada, Mexico is going to be in worse shape because of all the Chinese plants that have been built along the border, and also German and other plants that are there taking advantage of the free trade deal to move cars into the States. I think Trump's going to take the hammer out, and of course his new Commerce Secretary is going to be dealing with the tariffs, and he's going to be pushing Mexico not only on the manufacturing business and companies with manufacturing there, pushing them to move some of the manufacturing, not all of it, but some, back to the United States. So in other words, if you have a plant that's doing X and you wanted to grow it by 20%, that 20% arm twist will be build it in the States and hire the people and have the workers in the United States. But I think in Canada's case, Ontario and Quebec manufacturing, given how close we are to such a large, part of the U.S. population in manufacturing, I think that's going to be a testier situation for Ottawa, depending upon who's in the government. If the Liberals are still in the government when a lot of these battles occur, that I think that the Prime Minister and Trump don't seem to get along. It's not like the love affair between Mulroney and Reagan. Let's go sing some Irish songs together. It's a different nuance. But if there's a change in government and Poilievre and the others, sound just like what the political stance is of the United States, there could be a more accommodating situation. But again, we won't know that until sometime in probably second half of 2025. Of when does the Prime Minister call the election?
President Trump is talking about instituting tariffs and reducing or eliminating federal income taxes. How could that affect energy markets?
Well, I don't see them removing income taxes. The tariffs can generate hundreds of billions of dollars, but remember they have a $2 trillion deficit, $36 trillion of debt. They spend $1 trillion a year on interest payments, and inflation, people are saying might be picking up again. I don't think that we're going to see lower, personal taxes by any substantial amount. The only way you could eliminate it is some of the libertarians, like the Rand Paul and his father would like to see a consumption tax, and we know what consumption taxes can be like in Canada. You see them in Europe. But unless the number is big enough to offset the personal and corporate income taxes, even if they're going to be reduced, when Trump extends the Trump tax cuts from 2016, I don't think that that's possible given the fiscal situation in the United States. Trump doesn't want to see $3-4 trillion deficits because that would really spike interest rates up and weaker dollar, and that would make things very difficult for the U.S. Internationally and competitively.
Now, of course, you were talking about a sales tax, a value-added tax. In the UK, it's 20%. And I know the last time I visited, that was a big deterrent for me to buy anything, even though they said you could get a rebate. Trying to get that rebate was almost impossible. Anyway, does the USMCA, the United States-Mexico-Canada Trade Agreement, have an energy component to it?
Yeah, there always was, and I think that's because for example, we ship a lot of crude oil to the United States. In some places, refineries in the States send product into Canada. I think that happens in between Washington State and BC. In Ontario and Quebec, you see refineries pass stuff through. There's pipelines going back and forth, north and south. So we already have a lot of trade that goes on between crude oil and product and chemicals, and it's such an integrated system that I don't think that there's going to be any major changes. There's still issues over in Michigan over the Enbridge pipeline that could be politicized again. But again, if we have a pro-energy government in Washington, I don't think that we'll see it. That pipeline closed. They may have to, the rebuild or the expansion, of it or movement of that would probably be an issue. But the closure period without a replacement, I don't think is a go. So that's a positive. It does cross over between Canada and the United States, and it is on a waterway where there might be some issues. But look, the engineers know how to do this stuff. They do it all the time, and I think a solution can be made. Between the U.S. Military's engineers and the engineers in the oil patch and government regulators. I think there's solutions, and I think this is not a big issue.
Are crude oil and natural gas pipelines likely a go under President Trump?
I think definitely, as we talked earlier, the XL pipeline, which everybody thought was dead and buried forever, and only the lawyers were benefiting from the legal suits. I think that the fact that he's brought this up tells you that how pro-energy he is. Remember, Doug Burgum, who's the Interior Minister, who is the one that is going to be allowing drilling on federal lands. The Permian has so much more capacity in New Mexico, and under the Biden administration, they said no, no, no. Offshore Gulf of Mexico, there's lots of potential. Off the east coast of the United States, for years, companies have wanted to find out if there's anything there. Alaska, we've seen the senator from Alaska on TV talking about Anwar and all the things that the upside potential from Alaska. So when I talked about 2 to 3 million, I was incremental production. I was talking about just the continental USA, if the potential of Alaska comes in, you could add another million or two. So America right now is the largest producer of crude oil in the world at 13.2 million barrels. The next is 9.1 is Russia, 9.0 is Saudi Arabia. Canada is 6 million, 5.9 to 6, and then you have China at 4.6. So if Canada and the United States together are quite the powerhouse of energy, I think that's if they want levers to make that economy start humming in the States, this is one of the good levers because the resource potential is there.
Is President Trump likely to open up Alaska for energy production?
Oh, I think that he's got a lot of support from Alaska to do it. He's got 53-54. I think 53-47 is the Senate. So he's got the approval in the Senate to do that. The Alaska government would jump through hoops to get it going again. The environmentalists will put roadblocks in the way, but the federal government has the final say. And under the Biden administration, it was no. Under the Trump administration, it's going to be yes, yes, yes.
U.S. natural gas prices now $3 per 1,000 cubic feet. Does this help Canadian prices?
Not yet. The cold weather in the West will help. We're about $1 an MCF. I saw just a few days ago. I think we need $2.5, $3 AECO, which is the Western price. So I think we need to see drawdowns. If you go to the U.S., the drawdown number that came on Wednesday was a negative. So we're in the drawdown season, and the East was down by 12 BCF. That compares to the -3 compares to 60 injection in 2023 and 36 injection on the 5-year. So we're finally seeing relatively good numbers. And if we get this cold spell and the weather you're talking about on the West Coast, we're going to see more drawdowns. What you want to see if you're a natural gas bull is you want to see sometime in December, January into February, multiple weeks of drawdowns of over 200, 250 BCF. And we have seen them in the past, but it's 1 week and then it's a normal week, maybe 50. What you want to see is multiple weeks. And in years when we've had multiple weeks of 200 to 300 BCF drawdowns, that's the years we see spikes in the price of natural gas, $5-6 or more. Right now, what's interesting is the cold weather in Europe with a lot of snow. You've got, I was on a webcast with Vermilion this week, and they were talking about prices in Europe between $15 and $17 US and MCF. So that's up 30% this year, simply because they have to import all of their natural gas by LNG, and they're going to be importing a lot. And there's even a report that I saw earlier this week that said that ships that were planning to take LNG from the Gulf Coast to Asia are moving and swinging around to take that gas to Europe because of the much better pricing there and the need for it there.
Is OPEC managing supplies to push crude oil prices higher?
I don't know if you can say that. The OPEC report, which I have in front of me, knowing we were going to talk about it, OPEC's production in the month of October, which is the data that came out on November 12th, showed an increase of 466,000 BOEs a day, or barrels per day, to 26.5 million barrels. And of that, Libya, of course, which had problems with the warring factions, got back to 1.1 million barrels. So the high they can do is 1.2, so they're very close. Nigeria, which also has, problems producing oil because of all the break-ins and problems with ruptures of pipelines, up 35. And Iraq and Iran, which have been pressured by OPEC to get back in line, Iraq cut their production by 66 to 4.1 million. And then Iran, I think this is more related to, the issue of people the insurance issues of taking oil from Karg Island to wherever the buyer is, be it China or India. The insurance rates probably went up because of the concern about Israeli, attacks on the infrastructure. So far, they've attacked military targets, So that really is, an okay so far. And with Saudi Arabia trying to talk Iran into lowering the temperature, that would be a good thing, especially if that happened, around inauguration time. So potentially Iran could be arm twisted to get Hezbollah and Hamas to want to do a negotiated, ceasefire, which includes freeing all the hostages and the bodies of the hostages that are not alive.
What's the latest on the Russia-Ukraine conflict and the possible impact on crude oil prices?
Well, every time there's an upping of the ante of weaponry, like we saw Ukraine's been given weapons that can fire 50 kilometers, 150 kilometers, and then 300 kilometers. They were not allowed to use the ones to 300 kilometers by the Biden administration until over a week ago. They fired them into a military depot deeper into Russia, and that was, of course, a big annoyance to Russia. So they started and fired back these medium intercontinental ballistic missiles into parts of Ukraine. And so instead of trying to lower the temperature and quiet things down and allow diplomacy a chance, the neoconservatives working in the Biden administration are trying to, put handcuffs on Trump and his new administration, where they can't, that they have to keep on supporting Ukraine in the fight, rather than saying, okay, Ukraine, you're not going to win the war. You're not, you've got to come to a diplomatic solution, because if you don't, we're cutting off our military and our economic support, which of course would be catastrophic for Ukraine. One thing I keep an eye on is Russia. The Ukrainians invaded an area called Sumy in the Kursk area, which they've taken quite a bit of land. They've held it. It's back and forth right now over it, and of course Russia wants them out before a diplomatic outreach comes from America under Trump. So they have 50,000, 40,000 Russian troops, 10,000 North Korean troops with new long-range artillery, and they're trying to knock these Ukrainian brigades out of that captured territory before January 20th. So I'd be watching the news flow on that, Economist magazine, BBC, or whatever, because if their Russians are successful with the offensive with North Korea, and of course North Korea wants a battle test and check all their weaponry and learn how to fight modern warfare. So Kim is supporting them with artillery shells, with long-range artillery, and with 10,000 troops. If they are successful in pushing the Ukrainians out of Russia, that's a game changer.
How are the third quarter Canadian energy earning reports looking?
Well, they're getting near the end. Companies that are natural gas focused, a lot of them have shut in dry gas, because they couldn't make money on it, even with hedging. And so you have some performances in the natural gas sector which are down from a year ago, lower cash flows, lower capital expenditures. Stock prices have been beaten up pretty hard. That's where a lot of bargains are. But also small and medium-sized oil companies that have natural gas components have not really shown growth in their production volumes for the most part because of the gas being a problem, and also because the whole cost issue. Also, if you remember, we had fires in the northern part of the province, which delayed projects as well this past summer. So the numbers for some of them were flat, and that could be good. For some of them, they were down, some materially down 15-20% in production. Cash flows down much more than that. So there are a lot of bargains out there. And the key is, you have, like when I was cautious on the price 6 months ago, there were a lot of bulls out there. And, if you remember in April, we had the stocks were at the high for the year for the energy sector. And everybody was thinking we're going, because of the prices were in the 80s, you were hearing people throwing around 90s. But I was starting to see weakening demand in the U.S. and clearly weakening demand in China, especially for diesel. And so I started saying, look, we could see prices go below 70. And if you remember, you and I talked, I thought we'd see between 66 and 68 a bottom. And then on September 10th, we did get there, and we sent out an action alert buy signal, and we put out 5 new buy recommendations. I think during this tax loss selling season, over the next 3 weeks, we're probably likely to see, we're at 71 today, so to get to 66, 67 is not a big step. I think we're going to see another buy signal kick in. We'll add some more new names to the buy recommendation list, and we'll be talking about some of those names next Thursday on our webinar. So if people out there would like to join the webinar, get our research on the company specific, they'll have to become subscribers and just go to our website, and they can take advantage of the the alternative, the annual or the quarterly.
We're in tax loss season. Do you think there will be some bargains out there?
Tremendous bargains. I have stocks that are down 50%, 60% from the highs at the beginning, from April. So there's tremendous bargains. The companies have, kept on focusing on getting their balance sheets in order. Some of them did have, production flat to growing a little bit. So those would be the ones I'd be pointing the finger at as saying, these stocks are down half of what they were. Many companies are trading below proved, developed, producing reserves, PDP, which is what banks lend against. And so historically, and they're trading under 2 times cash flow in many cases. So if you go to the top of a market like we did in 2008, you had companies trading at 2P valuations and at 5 to 7 times cash flow. So if we have rising commodity prices, as I said, $90 in Q4 of 2025 and maybe $100 in 2026, you've got rising commodity prices, which means your reserves are worth more. You're going to probably see production volume increases, and you're going to see multiple expansion. So to me, energy is in a fabulous position for investors who are patient, who do their homework, and are willing to invest for a number of years. I think the potential in many of the companies are 3 to 5 baggers between now and the end of the decade, which is, to me, pretty attractive.
What kind of prospects do you see for deep drilling for geothermal water for energy purposes?
I don't know enough about it, but there is some geothermal drilling occurring in the States. There's drilling for lithium brines in Canada. Some of the drilling companies talk about that. Ensign did on their conference call. And so you are seeing windows where the rigs are not being used for drilling in the major basins, and then they go to drill these one-off wells for companies that are, doing more of a R&D side of seeing, if there's something of economics there. I remember when I started in the business in the 70s, I flew down to San Francisco because a Canadian company was drilling for geothermal, and they had quite a bit of success, but it wasn't a big enough thing to, move the meter relative to the demand for energy in the San Francisco community.
Where can people subscribe to the Schachter Energy Report to see your tax loss season stock picks?
Yeah, it's not only you'll see that in the write-up. We cover 14 companies in the report that comes out next Thursday, and there's some great opportunities there. But being on that webinar next Thursday, I think, is really valuable because I do the macro overview, talk about tax losses, talk about the same things you and I have talked about related to, Trump and the energy industry and how they'll treat Canada, and what about tariffs in Canada, et cetera. But then we're going to go through quite a few of the best ideas that I have and go through them in detail of what makes them so attractive, what the value perspective is there. And we'll be having that starting at 7 p.m. Mountain Time next week, Thursday. So please join us. How do you subscribe? You go to www.Schachter, Schachter, energyreport.ca, and then you look under subscriptions. You'll find there the quarterly or annual alternative, and you'll also see the Ion Energy, which is the complementary product, which we use to let people know what we're thinking, and then it's almost a marketing document to, if you really want to know more about company specific, that's the paid product.
Joseph, thank you so much for being on This Week in Money.
My pleasure as always.
My guest has been Josef Schachter, founder of the Schachter Energy Report online at Schachter.Energyreport.ca. He was speaking to us from Calgary. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Eric Hadik, Josef Schachter, and thank you for listening. If you have any questions for the show or for our guests, you can send them to info@HoweStreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at TalkDigitalNetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen.